The market is flashing a massive green signal right now, and if you are looking at your screen, you are seeing Confluent Inc. NASDAQ CFLT trading at exactly 29.74 USD, ripping higher by a staggering 6.60 USD, which translates to a 28.52% gain on the day. This is not a drill. And this is not your standard market drift. The price action we are witnessing this morning on Confluent is the kind of violent, vertical repricing that happens when the entire thesis of a company changes overnight. If you woke up expecting Confluent to just be another volatile mid-cap software stock moving in sympathy with the NASDAQ, you have been handed a completely different reality. The expectation was that Confluent would continue its slow grind of proving profitability in a high interest rate world. The reality? IBM has just stepped in with a definitive agreement to acquire Confluent for $31 per share in an all-cash deal valued at approximately $11 billion. This gap you are seeing on the chart, this massive jump from Friday's close of around $23 to nearly $30 this morning, is the market instantly pricing in a massive corporate takeover. But here is where it gets interesting, and this is why you need to pay close attention if you are holding this stock or thinking about stepping in. The offer is $31. The stock is trading at $29.74 USD. That difference, roughly $1.26 per share, is what Wall Street calls the arbitrage spread. It is the market's way of saying, we believe this deal happens, but we are leaving a tiny margin of error just in case the regulators step in. Most retail investors seeing this on their Robinhood app or checking their Fidelity Investments dashboard might just see the big green percentage and think, wow, I missed it. But the sophisticated money is looking at that $1.26 spread and asking a deeper question. Is there a chance this deal gets blocked? Or worse, is there a chance someone else, maybe a Google or an Oracle, steps in with a higher bid? That is the tension fueling the tape today. The volume is absolutely exploding. We are seeing over 45 million shares traded already, obliterating the average daily volume of roughly 7 million. This is capitulation from the shorts who got caught betting against the data streaming narrative. And it's a rush of arbitrage funds stepping in to capture that final 4% spread. Let's back up and look at the psychology here, because it is fascinating. For the last year, the narrative around Confluent has been mixed. Investors were worried about consumption-based pricing models slowing down. You had analysts from big banks downgrading the stock, citing macro headwinds. If you hold individual brokerage accounts, you probably saw those hold or sell ratings popping up in your newsfeed. The expectation was that Confluent was a great technology, but a difficult stock. That was the consensus. The reality, however, was clearly visible to the corporate strategists at IBM. While the market was fretting over quarterly billings, IBM saw the critical infrastructure that Confluent provides. They didn't see a software stock. They saw the central nervous system of the modern AI enterprise. And that is why this move is so significant. It validates the entire sector. If you look at NVIDIA stock, the story there is about the chips that process AI. Confluent is about the data that feeds those chips. You cannot have one without the other. And today's acquisition proves that legacy tech giants are willing to pay a massive premium to own the data pipeline. If you're sitting there with your coffee wondering if you should sell your shares now at $29.74 or hold out for the full $31, you are playing a game of probability. On interactive broker stock trading platforms, you can actually see the options chains adjusting to this new reality. The call options that were way out of the money are now deep in the money, and the implied volatility has just crashed because the buyout price effectively caps the upside, unless, of course, a bidding war starts. This brings us to the broader market context. Today is Monday, December 8th, 2025. The general tech sector is having a mixed day, but Confluent is sucking all the oxygen out of the room. When you see a move like this, it often triggers a ripple effect. Traders start looking for the next Confluent. They start scanning their Schwab Intelligent portfolios or their SoFi Invest watch lists for other beaten-down software infrastructure names. It creates a hunt for quality mentality. People realize that if IBM is willing to pay $11 billion for Confluent, maybe the valuations on other data stocks aren't as crazy as they seemed last week. Let's discuss the intraday mechanics we are seeing right now. The stock opened this morning with a massive gap up. It didn't even trade through the $24, $25, or $26 levels. It just teleported to $29.80. Since the open, it has been pinning very tightly to this $29.70 to $29.85 range. This is classic merger arbitrage behavior. The algorithms are programmed to buy anything below a certain threshold and sell anything that gets too close to the $31 offer price, factoring in the time value of money until the deal closes. If you're a day trader using a Fidelity trading platform or similar tools, you are finding very little volatility in CFLT right now compared to, say, Tesla stock, which might be swinging 3 to 4% on a tweet. CFLT has effectively become a cash proxy, tethered to the deal terms. But do not ignore the massive volume. 45 million shares changing hands means the stockholder base is rotating. Long-term growth investors who wanted a 10-bagger are exiting because the upside is now capped at 31. They're taking their 28% win and moving on. Who is buying? The arbitrage funds. These are massive institutional pools of capital. Think of the specialized desks at Fidelity Wealth Management or hedge funds that specifically buy buyout targets to capture the spread. They are buying your shares at $29.74 to make that $1.26 profit when the deal closes in a few months. It sounds small, but annualized, that's a safe, high-yield return for them. But why Confluent? Why now? To understand this, we have to look past the ticker symbol and look at the company itself. Confluent was founded by the creators of Apache Kafka. If you are not a software engineer, that might sound like nonsense, but think of it this way. In the old world of databases, data was static. You stored it in a box, and when you needed it, you went and looked in the box. That's how traditional banking and inventory worked. But in the modern world, the world of Robinhood crypto transactions, Uber rides, and Netflix recommendations, data is always moving. It's a stream. Apache Kafka is the technology that handles that stream. It is the plumbing that allows data to flow in real time across an organization. Confluent is the commercial entity that makes Kafka easy to use for big enterprises. IBM buying Confluent is IBM admitting that the future of hybrid cloud is not just about storing data, it's about moving data. They acquired Red Hat for the operating system of the cloud. Now they are acquiring Confluent for the nervous system of the cloud. It's a strategic masterstroke, even if the price tag feels high to some value investors. This acquisition fits perfectly into the trend of online investing and digital transformation that we have been talking about for years. Whether you are using SoFi Active Investing to buy fractional shares or you are running a massive pension fund, the companies that you are betting on are all trying to become real-time businesses. Confluent is the company that sells them the tools to do that. The expectation from the skeptics was that open-source software, since Kafka is free, would prevent Confluent from ever being truly profitable. The reality, validated by this $11 billion check, is that enterprises are terrified of managing this complex infrastructure themselves. They would rather pay Confluent and now IBM to do it for them. I want you to take a moment and think about your own portfolio. Comment below how many shares of Confluent you currently hold, or if you were watching it from the sidelines and missed this pop. It's always painful to watch a stock you were meaning to buy suddenly jump 30% in a second, but that's the nature of the market. Let's pivot to the risks, because even with a signed deal, the game is not over. The biggest risk here is regulatory. We are living in a climate where big tech mergers are scrutinized heavily. The FTC and global regulators look at an $11 billion consolidation in the cloud space, and they might ask questions. IBM is a giant. Confluent is a leader. Does putting them together hurt competition? The market pricing the stock at $29.74 instead of $30.80 suggests there's a mild fear of this. If the deal were guaranteed to close tomorrow, the stock would be at $30.98. The fact that it's trading at a discount shows that interactive brokers and the smart money are hedging their bets slightly. Another scenario to consider is a competing bid. Could we see a bidding war? It's unlikely, but not impossible. A company like Oracle or even Microsoft might look at this and say they can't let IBM have this technology. If a second bidder emerges, this stock will rip through the $31 ceiling and head towards $35 or $40. Remember, Confluent traded at over